What if the very lifeblood of our modern civilization is being systematically throttled by forces that the average investor completely refuses to see? We are standing at a terrifying precipice where the cost of moving goods, the cost of heating homes, and the cost of capital itself are colliding in a way that has not happened in over 50 years. The era of cheap energy and cheap money is officially dead, and in its place, a new and far more dangerous reality is emerging rapidly. Hello, this is Warm Insight. Today, we are going to talk about the escalating global energy dynamics and the geopolitical fault lines that are threatening to fracture the world economy. Leaving a like and subscribing is a huge help to us. Imagine the global economy as a massive supertanker trying to navigate a narrow, stormy strait. On one side, you have powerful geopolitical currents, creating whirlpools in oil supply, making it hard to find a steady path. On the other, the central bank is tightening the steering, making the ride bumpier and slower. And now rogue AI-powered pirates are trying to hack the ship's navigation system, threatening to send the whole vessel off course. This is not just a metaphor, it is the literal reality of the 2026 market. To truly understand the weight of our current situation, we must first look at the weaponization of energy and the collapse of supply. When we see headlines about Iran seizing tankers or the United States striking oil vessels, we are not just seeing localized conflict. We are seeing the return of the energy embargo as a primary tool of statecraft. To find a proper historical parallel for this exact type of supply chain collapse, we have to look all the way back to the fall of the Roman Empire, and specifically its reliance on grain from North Africa. For centuries, Rome was the undisputed center of the world, and its massive population was entirely dependent on a highly optimized, tightly controlled shipping lane that brought grain from Egypt and Carthage straight to the heart of the empire. The citizens of Rome never thought about where their bread came from. They just assumed the ships would always arrive. But when the Vandals crossed into North Africa and seized the grain-producing regions, they did not need to march an army on Rome to defeat it. By simply cutting off the supply chain, they triggered massive inflation, starvation, and the eventual collapse of the greatest superpower the ancient world had ever seen. The exact same vulnerability exists today, but instead of grain from Carthage, it is crude oil from the Middle East, and instead of Vandal fleets, it is state-sponsored seizures in the Strait of Hormuz. We saw a brief flash of this during the 1973 oil crisis, when the OPEC nations declared an embargo, and the price of oil quadrupled overnight, bringing the Western world to its knees. Today, the United States Strategic Petroleum Reserve is being depleted to dangerous levels, removing the very buffer that was built to prevent another 1973 scenario. We have built an empire on just-in-time energy delivery, and the barbarians are currently at the gates of our shipping lanes. The psychological root of why the general public and even seasoned investors completely ignore these glaring red flags lies in a powerful cognitive flaw known as normalcy bias coupled with the availability heuristic. Human beings are biologically hardwired to believe that the future will look roughly exactly like the immediate past because we have lived through 30 years of relatively cheap and abundant energy, driven by globalization and technological leaps in shale drilling. We find it cognitively impossible to prepare for a world of permanent scarcity. Our brains treat the global energy grid like the oxygen we breathe. We only notice it when someone starts choking us. This bias leads investors to severely underprice risk in the energy sector. When they see a tanker seizure on the news, their brain categorizes it as a temporary anomaly, rather than a symptom of a collapsing global order. We are programmed by evolution to seek patterns of stability to reduce anxiety. But in doing so, we become completely blind to the black swan, events that actually dictate the course of history. People prefer the comfortable lie of a temporary price spike over the incredibly uncomfortable truth of a permanent structural shift in how the world operates. To put this into a fifth-grade analogy, imagine you live in a quiet neighborhood where there is only one grocery store, and it is located 10 miles away. Every single day, a friendly delivery truck brings fresh food right to your front door. You never once think about where the food comes from, how the truck gets there, or what kind of fuel it uses. But one day, a neighbor gets into a violent argument with the truck driver and blocks the main road with a pile of rocks. Then another neighbor decides to start charging the truck a huge toll just to pass their house. Suddenly, the fresh food in your fridge starts disappearing. and the price of a single apple goes from $1 to $10. You realize far too late that you did not actually have a reliable food supply. You only had a fragile delivery service that relied on absolutely everyone playing nice. Right now, the global energy market is that exact delivery truck, and the global neighbors are starting to throw very large rocks into the street. The second massive pillar of this unfolding drama is the Federal Reserve's iron fist and the persistent hawkish monetary policy that is crushing capital allocation. Even as the energy sector screams for fresh capital to build new refineries, drill new wells, and stabilize the grid, the cost of borrowing that capital is reaching heights we have not seen in decades. This creates a lethal paradox in the market. To solve a physical supply crisis, you desperately need physical investment. But to stop inflation, the Federal Reserve is making that exact investment prohibitively expensive. Historically, this mirrors the brutal economic environment of the early 1980s and the controversial reign of Federal Reserve Chairman Paul Volcker. At that time, inflation was a runaway freight train, destroying the purchasing power of the middle class. And the only way Volcker could stop it was to jack interest rates up to nearly 20%. It worked, but it caused a devastating recession, a wave of bankruptcies, and a massive, painful shift in how capital was allocated across the globe. We are currently in the early stages of a very similar macroeconomic reset. The Fed is aggressively signaling that they will keep rates higher for much longer, even if it heavily weighs on stocks and buoys Treasury yields. They are effectively choosing to break the broad economy in order to save the underlying currency. In the 1980s, this hawkish stance led to the absolute collapse of many heavy industries that relied on endless cheap debt to survive. Today, the victim is the energy transition and the critical maintenance of legacy fossil fuel infrastructure. By keeping interest rates elevated, the Fed is ensuring that only the absolute strongest, most cash-rich megacorporations can survive the coming winter, while smaller drillers are starved of the credit. They need to bring new oil to the surface. Psychologically, this high interest rate environment triggers intense loss, aversion, and massive recency bias among retail investors and even institutional fund managers, investors who grew up and built their careers in the post-2008 era of 0% interest rates and endless quantitative easing are currently in a state of profound shock. They keep stubbornly waiting for the pivot. They are waiting for the magical moment when the Fed swoops in to save the stock market, but they fail to realize that the Fed is no longer looking at the S&P 500. They are looking at the terrifying price of bread, housing, and gasoline. The human brain feels the pain of losing money twice as strongly as the joy of gaining it, which leads to irrational panic selling during every single hawkish press conference. This herd behavior creates massive, unpredictable volatility. People are acting entirely out of primal fear, rather than deep fundamental analysis. They see the high interest rate as a monster under their bed, entirely failing to realize that the monster is actually the bitter medicine required to cure a much larger and deadlier disease called currency debasement. Think of it like this. Imagine you are riding in a massive heavy truck, driving down a steep twisting mountain road. The truck represents the global economy, and it is picking up way too much speed. That terrifying speed is inflation. The driver, who represents the Federal Reserve, starts slamming on the air brakes as hard as he can. The brakes are the interest rates. The passengers in the back are angrily complaining because the sudden aggressive braking is making them spill their drinks and giving them terrible whiplash. They are screaming at the driver to let go of the brakes so they can be comfortable and relaxed again. But the driver knows for a fact that if he lets go of those brakes, the heavy truck will completely fly off the cliff at the very next sharp turn. The passengers are entirely focused on their spilled drinks and their momentary discomfort. But the driver is focused on the fact that the wheels are about to catch fire and the cliff is approaching fast. We as investors are currently those short-sighted passengers complaining about the spilled drinks, while the Fed is desperately trying to keep the entire vehicle on the road. This brings us to the third, and perhaps most terrifying pillar of the modern energy landscape, the exponential rise of artificial intelligence-powered cyber threats, targeting critical infrastructure. The International Monetary Fund has recently issued severe warnings that artificial intelligence is making cyber attacks cheaper, faster, and exponentially more dangerous. This is not just about a hacker stealing your credit card number or taking over a social media account. This is about rogue nation-states and stateless actors using generative AI to find invisible zero-day vulnerabilities. In the highly complex software that manages our power grids, our oil pipelines, and our global financial clearing systems, looking back at history, the closest and most accurate parallel to this invisible war is the development of advanced signals, intelligence, and cryptography during World War II. The breaking of the German Enigma code by Alan Turing and his brilliant team at Bletchley Park completely changed the course of human history. By making the invisible communications of the enemy suddenly visible, it allowed the Allies to anticipate submarine wolf packs and cut off supply lines without firing a shot. Today, artificial intelligence is the new Enigma machine, but it works in terrifying reverse. It allows attackers to create invisible, untraceable backdoors into the critical infrastructure that keeps our modern cities from descending into chaos. During the Cold War, the entire world feared a massive nuclear exchange that would physically level major cities and turn the earth to ash. In 2026, the great fear is a silent digital exchange that shuts off the lights, freezes. Every bank account stops the flow of clean water and halts every supply truck in the country without a single physical bomb being dropped. The systemic risk to our financial stability and energy grid is now sitting at 90%. According to the latest institutional risk heat maps, we are actively building a highly advanced high-tech civilization on a digital foundation of sand. The psychological root of our catastrophic failure to properly address this existential threat is known as hyperbolic discounting. Combined with the neglect of probability, the human brain finds it incredibly easy to ignore a massive threat that it cannot physically see or touch, because the vast majority of us have never experienced a total, prolonged digital collapse of the energy grid. We simply assume the probability of it happening is near zero. We aggressively prioritize small, immediate gains over long-term survival and security. This cognitive flaw is exactly why massive corporations will happily spend billions of dollars on flashy marketing campaigns, but will only spend pennies on upgrading their legacy cybersecurity systems. We are cognitively biased toward the physical world. If we see a foreign tank rolling down the street, our amygdala fires and we feel instantly threatened. But if we see a string of malicious code quietly altering the pressure valves in a natural gas pipeline, we feel absolutely nothing. This profound psychological disconnect is exactly what sophisticated AI attackers exploit every single day. They know perfectly well that our primitive human brains are simply not equipped to perceive or react to the speed, scale, and silence of an AI-driven assault. To explain this terrifying concept to a fifth grader, imagine you live inside a giant, beautiful stone fortress. It has incredibly thick walls, an iron gate, and a deep moat filled with water. You feel completely safe from any army that might attack from the outside. But instead of an army attacking the walls with loud cannons and tall ladders, the enemy simply sends in a tiny, invisible ghost. This ghost does not need to break down the walls or fight the guards. It just calmly walks right through the front door and quietly changes all the locks on every door while you are sleeping. When you finally wake up, you find that you are completely trapped inside your own beautiful house. And the invisible ghost is now the one in charge of the kitchen, the water, and the heat. You spent all your money and time building strong stone walls, but you completely forgot that the locks were actually the most important part of the castle. Right now, our global energy grid is that stone fortress, and weaponized AI is the invisible ghost that is rapidly learning how to pick every single lock in the world simultaneously. Now we must turn to the contrarian view, because where there is immense chaos and panic, there is also incredible generational opportunity. While the herd is panicking and fleeing from market volatility, the smart money, the truly institutional capital, is quietly looking for the generational bargain. The mainstream news that oil sands growth is completely drying up in Canada, or that U.S. drillers absolutely cannot solve the global supply crisis, might sound like a terrifying reason to sell your energy stocks. But to a hardened contrarian investor, it is a massive, flashing buy signal indicating a long-term structural supply crunch that will immensely benefit the few survivors who already hold the physical assets. Historically, the greatest fortunes in human history have always been made by those who have the courage to buy when there is literal and figurative blood in the streets. Consider the legendary actions of Baron Rothschild during the Napoleonic Wars, when the entire market believed that the British were losing the Battle of Waterloo, and panic swept through the London Stock Exchange. Rothschild was quietly, aggressively buying up every single depressed asset he could get his hands on. He deeply understood that the geopolitical panic was entirely temporary, but the intrinsic value of physical land, infrastructure, and government bonds was permanent. In the energy sector today, we see massive companies with established, irreplicable assets that are currently being valued, as if fossil fuels will simply disappear tomorrow. The barrier to entry for any new competitors to build a refinery or lay a pipeline is now higher than it has ever been in human history because of soaring interest rates and crushing environmental regulations. This means the existing titans of the energy industry possess an economic moat that is wider and deeper than it has been in a century. The psychological root of this contrarian edge is the rare ability to completely resist the powerful pull of social proof. We are deeply social animals evolved to survive in tribes. If we see everyone in our tribe running screaming in one direction, our biological instinct is to immediately follow them without asking questions. It takes a truly unique neuro-philosophical constitution to stand perfectly still, while the entire crowd is sprinting past you in terror. The fear of being wrong and alone is almost always significantly stronger than the desire to be right and wealthy. But in the financial markets, the crowd is almost always violently wrong at the extremes of emotion. By deeply understanding that the current market fear is a product of ancient biological conditioning rather than cold mathematical reality, the master investor can deliberately decouple their emotional brain from their capital allocation strategy. Think of it like this. Imagine it is a beautiful sunny day at a crowded beach. Everyone is playing in the warm water building, sand castles, and buying cold ice cream. But you happen to notice that the tide is suddenly going out much, much further and faster than usual, exposing the bare ocean floor. You remember reading in a book once that this strange phenomenon is the universal warning sign of a massive incoming tsunami. You immediately start walking away from the fun and heading straight toward the high ground. Everyone else on the beach laughs at you, pointing and asking why you are leaving such a perfect party. They genuinely think you are crazy because they do not see the massive wave yet. But by the time the giant wall of water is finally visible on the horizon, it is far too late for them to run. A contrarian investor is simply someone who pays extremely close attention to the shifting tide, while everyone else is distracted by the taste of their ice cream. As we look at the exact survival mechanics for this highly volatile era, we must fully embrace the concept of the global shield and strategic asset allocation. A balanced portfolio in 2026 absolutely cannot rely on a single country, a single currency, or a single energy source. We must use disciplined dollar cost averaging to systematically smooth out the violent volatility. We cannot perfectly time the bottom of a geopolitical crisis, but we can definitely ensure that we are always mathematically moving our capital into positions of long-term strength.